And then I sold the June 19th covered call for $11.44 premium. BA has skyrocketed to 183 per share. Larry sent this comment to the YouTube video on Thursday night before this morning. All right. Now, to roll it up and out next month would be $64.20 per share to buy back, and not sure which option to roll to. If I roll the cost basis, it's going to skyrocket, and I don't think BA will hold. He's curious to know how he will proceed. Well, after a little bit more discussion, we found out that it was the 132 strike for June 19th that he had sold for $11.44. Now, this was likely a defensive position, and you can see that because he purchased the cost base of the stock is 145. He sold the 132 call for 11.44, so the max you should expect back is 133.56. I'm sorry, yeah, 133.44. My apologies. So we're underwater. Let me get the numbers right. 143.44. So we're underwater by $1.56. So the guaranteed percent if assigned is a loss of 1.2%. Now, Boeing shot up today, of course. And in the morning, it went as high as almost, I think, 220 or 221 before settling back down. It was at 207 when I was putting this together at about 3 p.m. And I actually did a video, but I wasn't happy with it, so we're going to do it now. And it settled, I think, at the end of the day at 204.60 or 204.50, somewhere along those lines. Remember, what are we holding here? He's holding the 132 strike. So now we're looking at about a $78, $76 buyback for that particular option. Okay, so I want to take a look at that. Now, our second commenter was VOWplay. He also has an issue. Will you address a covered call for BA entered May 20th, 2020 with the 170 June 2022 strike? So we're out to 2022, about 740 days away at the 170 strike. $41 premium, cost basis on the stock was $139. Now, VOW is in a much better position. Not to say that we're in a bad position with Larry, and we can do some adjustments on it as well. But this position is so far out in time. The break even is down to $98 per share because of the far out premium. We're going to be sitting on this position for 740 days as well. Okay, so that's a pretty long time to be waiting on this position to get that premium and that return. I'm not sure if it totally matches the risk reward that they were looking for, but in any case, that's where they stand. Now, Terrie's in a much different position. Terrie's in a married put on BA, and of course, the stock is gapped up, so now her put, her protective put, is 20 points out of the money. BA is appreciating. Now it is above the protective put by 30 points. Her expectations is that it will continue appreciating, probably to 300. She has a different sentiment than what Larry had as well. I don't know the specifics of Terrie's trade. That's okay, because we've got a structure that if I entered Boeing on May 27th, the stock was trading around 149.52. I may have bought an October 170 put for $35.75. Now this makes my total cost basis per share $185.27, but we're guaranteed to get 170 back. So the max risk is 15.27 or 8.2%, a little bit on the high side, but this is a structure that I'd consider for a married put. Now with the stock at 204, it's similar to what Terrie was saying. It would be 30 points above my put strike price, and it's lost about 2/3 of its value. I think it's around $10 per contract at this point. Maybe it was 15. I'm sorry. It lost 20 points at $15 per contract. So 3 different stories, same stock. Let's address each. We're going to go to Power Options. We're going to take a look at the portfolio tools. We're going to look at the rollout opportunities that are shown for the BA covered calls and the married put, and discuss other potential rollout opportunities. Now, of course, we are going to be talking about the covered call position and the married put position. But I want to remind everyone as we go through this that the Power Options Portfolio tools we're going to show works for just about any of the 23 strategies we support on Power Options. Whether you're doing long calls, long puts, or other positions, you'll be able to track and manage those and evaluate rollout opportunities. So let me go to My Portfolio. We're going to click on the Portfolio tools. We've got the married put here, and then we've got our 2 covered calls from Larry and from VOW. Okay? And of course I didn't put the right date in, but I've got their prices incorrectly. Let's take a look at Larry's position first. So when I've looked at a position, when I'm in the portfolio, when I scroll over here, it's because I'm using a bigger resolution so you guys can see it better. But if I look at the analysis view here, this shows me 6 extra columns or so where I can see my original expected gain or loss underwater on this covered call, if assigned. My current liquidation value, pretty close to the expected max return in this case, and, of course, the expiration gain or loss, meaning if the stock stays at the same price it is right now through expiration, what would my position be? But to evaluate more details, anytime you're tracking a position in PowerOptions, use the More Information button to the side, go to Position Actions and Position Analysis. Now this is going to pull up a breakdown of your position. Let's see, I have 1.3% of my time value. We've got our cost basis of 145, 132 call sold at 1144. If we signed, we know we make that loss of 1.2, 1.3%. We saw the liquidation value, but we can get further details here by clicking the details link to see the math behind the original position, if it included commissions or not, the liquidation value, and then of course our future expiration value if we want to see more details. So we know where we stand. We're likely going to see a loss of 1.4, 1.2% at expiration. Now we scroll down below the listed trades and we see potential rollout opportunities. Now, Larry's question was, what should I be focusing on? Which option do I choose? Where do I go to? Well, right away, in this kind of situation, my eyes are going to gravitate to what? It's showing me potential rollout opportunities that are still showing me a loss. Why? Because it's less of a loss than we take right now. We could roll up to some of those strikes and take less of a loss. But I'm definitely going to focus on the positives. Keeping the same days to expiration. The stock now jumped up to 204, 205. Staying 14 days away to expiration, we have a loss of 1.2% now, but we could roll up and actually get a 4.4% return if we went to the 205 strike. Same expiration. We didn't have to increase time. Now, we will have to roll for a debit because it's going to cost us $76 to buy to close the call. We can't avoid that if we're looking to roll. There's no magic trick to avoiding that. So we took in 11, payback 76. We're going to be down to about $65 per share or so. Okay, 65.44. And we're only getting $13.20 back, so that's going to increase our debit to $51.36 or so. Okay, it's going to increase the cost basis. Although the higher return is nice, what else doesn't this 210 or 205? Hey, the 215 goes up to a 7.5% return if you're assigned at 215, but with a debit of $54.91. But what doesn't that match? That doesn't match Larry's expectation, does it? Larry's concerned, opposite of Terry, Larry's concerned that the stock is not going to hold at this price and might pull back. So in that case, I'm probably focusing here, maybe at the 190 or the 192.5. Is it worth it? Well, if I do nothing for the next 14 days and I get assigned at the 132 strike, we lose 1.2%. But by increasing the cost basis, even having to roll for a debit, if we get assigned at 192.50, that's a 1% return. We changed a loser into a winner, not a great return. We missed the great run. We didn't leave the upside open, one of the faults of the covered call positions, but we could turn the loser into the winner by staying in the same time frame. Naturally, the instinct is to roll for a credit, but with this type of debit, 4 or 5 times higher than the original premium received, we could scroll all the way down this list and go into January expirations and October expirations, September's, and still not be able to roll for credit on the position. Although we see 12.2% return, but that would increase it to 105 days out in time beyond the 14 we are right now. So what is the best one? Well, there is no best one. There is no one that I can say is the best roll opportunity. What I will say for Larry is that because he thinks the stock's going to pull back, it's probably safer to stay in the 190, maybe 192, maybe 187 and a half. But we could roll further out, absolutely. I could roll to June 26th to the 190 to get a 1.4% return, essentially flipping my current loss to the current gain. That's fantastic. And if there even is a pullback and we're only extending it by 7 days, from the 19th of June expiration to the 26th weekly, we could, of course, go out a full month, go out to 2nd of July, 27 days away. That 190 strike would be a 2.1% return. That makes about sense. It's a little bit more than double of what we would do if we rolled and kept the 14 days, but rolled up to the 190 call. Okay, so this is helping repair it. This is helping you get out of a loss, but it's going to be very difficult, of course, to make back what we lost with that sudden increase because you have to pay so much to buy it back. Now, it's great to see things numerically, but it's always better to see things graphically. So as you're evaluating the rollout opportunities, just click that More Information button and go to Simulate Trade. And now you have a side-by-side comparison. The position on the left is our original Boeing position. The current return is a loss of 1.4% and a potential max loss or max return of a loss of 1.2%. But rolling out here at midpoint is going to give us a little bit better premium on the position, a little bit higher strike price at the 190, and this was, of course, going out to July 2nd, 27 days away, so we could easily turn the loser into a potential winner. Now, a comment comes in, well, you should be trying to roll for a credit. Well, we didn't see any rolls for a credit, but it stopped at September. But we could always simulate what the roll would look like if we did try to roll further out. So let's go to the what-if calculations. That's going to take us directly to the profit and loss chart for our portfolio position. We sold the June 132 call. So let's simulate just buying that back. So we're going to scroll down here. We're going to add that back in. Okay, so it shows me that it's been added. And we're going to just simulate buying back the 132 strike. Let's put it at a normal price, $73.75. How about that? Okay, close to midpoint, pretty good. Why am I just doing that? Because I want to see two things. Number one, this puts me at a cost basis of $207.31 based on the increase in price. Not selling the next call yet, just buying back the original short call. So a trick I like to use is I'm going to just simulate that. We're going to take out our two calls, and we're going to put in our price to share of $207.31. Okay? But we know it's going to cost us $73.75 to buy to close the 132. Can we go out to January and get $73.75 at a higher strike? Again, let's go to View Options. Let's go out to January 2021 first. And let's scroll down to the options that might make sense. And even going to the 135 strike, it probably give us that credit, but what are we doing? We'd roll for a credit of an extra $2, but we're only increasing the return by 5 points. That's not giving us much of this unrealized gain that we've seen. Going out to our target maybe of 190, you're going to get a little bit more than half of that back. You're going to be at about $42 or $43, but you're not getting the 76 back. Okay? Let's go out now further. Let's go to January 2022. Let's look at the 190 there. See, that's not even at the $73, $74. And again, this is where VOW is. Oh, I'm sorry, VOW is in June. This is 595 days away. But let's just talk about that. Let's sell the 190 call. We're going to get about $61, $62 back for it, and we've increased the payout by $58. So with our new cost basis of $207.31, selling the 190 call, 595 days out, would give us a return of 30.3%. With a break even, down now to 145.81. But we didn't roll for a credit. We increased the return, but that's for almost 600 days out in time. So Does that match your goals for this position, Larry? Is that something that would be worthwhile for you to do, to be sitting on this position likely for 300, 400 days, realistically closer to 550 days before you start seeing relative time decay? You'll see time decay against this position naturally, but if it keeps going up, it's going to be, well, we'll address that when we get to VOWs in just a moment. So the rollout opportunities give you a great idea. And based on not just what the new return is, also think about your targets. What do you think the stock's going to do next? If you think it's going to appreciate, rolling to the higher strikes would give you a higher debit. You're not going to get as much premium, but you may see a good double-digit return. But that's if and only if the stock continues. For Larry's fears, he fears the stock's going to pull back. And rolling just to the 190 to stay below the current stock price a little bit doesn't give you too much, staying in the same expiration. But I think we saw some good examples of turning a loser into a winner. Maybe going out to that 190 strike there. Yes, you're going to increase the cost basis, but you're going to potentially get a 2.5% return on that position. And depending on your outlook, you may not want to roll further out in time. But you can analyze that, as we just showed, using the custom spread tool or the what-if scenarios. Now, very quickly, let's take a look at VOW's position. Cost basis of $139. Got $41 for the 170 call on or around May 20th. As we saw, the position had a max return of 73 or so percent. But this is all the way out to 2022 June. Why does that complicate things? Well, the same reason we sort of just mentioned in this position for Larry. If he did roll out to the January 2022, you have to wait for the time value to decay to make sense to roll. Now, VOW doesn't have his back against the wall per se. He's in a very strong position. As you can see, in fact, if he liquidated right now, he's made 29.5%. That's 40% of the expected max return of that 73.5%. The interesting thing here is that no rollout opportunities are shown. Why not? Because his back isn't against the wall, but his front is sort of against the wall, for lack of a better term. Meaning what? Well, let's take a look at the what-if scenarios here. We sold the June 2022, 740 days out, 170 call for $41. VOW can't roll out. He can't roll out in time to look for a credit. All they can do right now is roll up. And does it make sense to roll up at this time? Well, let's think about it. Again, we'll simulate this change. We'll buy to close the 170. And let's just roll up to, let's say, the at the money or slightly out of the money 210. Maybe the 215. Let's go with the 215. Give us a little bit more breathing room. Okay, so we're going to add that in. Buy to close the 170. Sell to open the 215. Where does this put us? Well, a debit of $20. Okay, so we're going to add to our cost base, going to increase the total cost basis on the position by about 20 points. However, we're also gaining 45 if we get assigned at that price. The return moves up from 73.5% or so to 82.2. Let's just call it a 9% increase. Well, is that worth it? Do we think the stock's still going to be strong and move up to 215 sometime in the next 200, 300, 400 days? Remember, this is 740 days out in time. Or just leave it alone right now, and if there's a pullback on the stock, as Larry's expecting, maybe buy it back at that time for a cheaper price. Maybe not as low as the premium you received it, or below that of the $41, but again, you might be able to buy back cheaper, then wait for it to appreciate to sell again. That depends on your expectations. But the portfolio tools didn't show any rollouts because there's no distance to roll to even try to roll for a credit or a mass increase return. You just have to stay in the same expiration. And you may be waiting on this position for an extended time. But again, you could liquidate right now for that 29% return if you wanted, or just wait on it longer. You originally sold it this far out in time for a reason. If your goal was to just hold it that long and get the 73% return off of your cost basis from what you collected, then you're good to go. Okay? All right. Now, last but not least, Terrie. In the Marriott put position, we talked a little bit last week and we posted the webinar on income method number 4, one of the 12 income methods we discuss in the blueprint related to the radioactive trading Marriott put positions. Now, even though the stock has moved up significantly, and this put that I entered for May 27th at 35.75 is down 20 points, that's still okay to adjust the put. You're still going to get benefit out of it. Let's take a look. Go to position actions here and position analysis. Even though I'm deep out of the money on the put, I'm in October, so I still have a good amount of time value. I'm at a liquidation value of 18.4% right now. That's always something to consider. And if I hold it to expiration, this means October. The stock stays at the same price, well, I'm only going to make about 10% return on that position. And that's assuming that the stock stays at the same price as well, okay? One second, folks. Here we go. Yeah, okay, I'm sorry about that. All right, so, all right. And so now at this point, excuse me, we see some opportunity to sell the calls, but that's not what Terrie was worried about. Terrie was more focused on rolling the put. And again, looking at the same example, if I keep the same expiration to October and just roll it up to slightly in the money to 210, I'd have a guaranteed profit, a bulletproof position of 3.3%. If I go higher to the 220, yes, I'm going to increase my cost basis. My new break-evens are going to move up to 203.25, 209.07, but I'm holding a 220 put, so I'm guaranteed a 5% return with still the expectation of the stock moving up in price. And if I'm wrong and it falls, as Larry's sort of expecting, I'm still guaranteed 5% on the position. Remember, liquidation right now is 18% on the trade. So this is still an opportunity to use income method number 4. It doesn't matter if it got away from you and it's deep out of the money. You now have a bulletproof position, no chance for loss on the trade, and you still have room for upside as your expectation is the stock is going to go up to 300. That's likely the approach that I would do, either the 210 or the 220 in this case for the October expiration. I wouldn't worry about increasing the time right now with the October put because I still have a good amount of time left. Oh, and I forgot to show this originally. My apologies. The original position was at an 8.2% loss. So I have no problem making one adjustment and adding to the cost basis to remove all of that initial at risk and now end up having a bulletproof trade with a guaranteed profit of 5% in the absolute worst case scenario, but still with time to go.